Normal, not normal. This market decline has been going on for 9 months, and by now you might be wondering if this is normal or perhaps not normal. We'll take a look at stock markets, Treasury interest rates, and inflation, CPI, and try to answer the question, is this normal or not? Now, the reasons for entering this decline and the reasons for the eventual exit are and will be different, as they are with all market cycles. Normal. Since the 1920s, the stock market has averaged about 10% return per year, and about 75% of years have had a positive return. With that many data points, that's about as normal as we can get. Not normal. The 10 years leading up to January of this year, the average has been about 15.8% return per year for the stock market, with just over 90% of years generating a positive return. That's 50% more return per year for 10 years. That's been good for investors, however, it's not normal. Next, let's talk about interest rates. The one-year U.S. Treasury bond yield hit 4% recently. Pause on that number for just a moment. 12 months, 4% return, nearly risk-free. So normal or not normal? The one-year U.S. Treasury bond started the year at about a 0.4% yield. That's a big increase, and seeing a 4% level now may seem abnormal, but is it? Going back to the 1960s, there have been several periods of rising and falling rates, with an average of 4.9%. We'd argue that 4% is historically average or normal. What has not been normal is the low interest rate environment we had experienced from 2008 until this year. Now, sure, we can debate monetary policy and whether there's a right amount of stimulus or quantitative easing, but our main takeaway here is that a 4% one-year Treasury yield level is normal. The 14 years of low interest rates leading up to this year were not normal. Next, recent high inflation. Seems not normal, right? Well, since the 1920s, inflation has averaged about 3% per year. Seeing a CPI, or Consumer Price Index, level of over 8% now has been not normal, but only based on our experience from recent history. The most recent CPI report was released this week. Overall inflation remained elevated, and certain components within the CPI basket are not retreating, such as housing, which continues to rise. When we look at the years leading up to this recent inflation spike, we've had a steady period of low inflation, which averaged about 1.7% per year. So again, we'd argue that several years of muted sub 2% inflation was not normal. Low inflation, monetary stimulus, and a strong performing U.S. stock market. For the past 14 years, investors have experienced this reality. Felt like normal. However, once we zoomed out, we find that the past 14 years were really not the norm. What we're experiencing now is quite possibly a return to a longer-term norm. As a result, uncertainty in these times can be high, and so too can market volatility as financial markets adjust to these new variables. If you have felt uncertain over the last 9 months, that is normal. For times like these where uncertainty is high, we especially advocate having a plan and using a bucket-based approach to planning and investing. This approach helps separate your short-term needs from your longer-term goals.